You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
All right, everybody. That music means it is time once again for Options Insider Radio, the interview program here on the network where we welcome on guests from throughout the world of options and derivatives and indeed beyond and proceed to pick their brains for you, the listener. My name is Mark Longo from theoptionsinsider.com, as well as, of course, on the Options Insider Radio Network. Pleased to see so many new earlobes and ear holes joining us every week here since the beginning of the year, really on. It's just been explosive how many people have been discovering the network. We want to keep that growth coming. A lot of people are learning about options for the first time in this turbulent and volatile year that is 2020. So help guide them to our doors, give them a safe shore. We'll be their lighthouse in these turbulent waters. So wherever you're listening to this, could be on the Apple Store, could be Google Play, could be YouTube, via our app and all the various stores. Wherever you listen to us, make sure you keep those reviews coming so new folks can continue to discover the network. Keep those questions coming too. Maybe you have a guest you think would make a great fit for our interview show, question for one of our legion of other shows here on the network, hitting you usually multiple times a day. You know where to find us at Options, most of the major social media platforms. So just go over to theoptionsinsider.com. Carrier pigeon, smoke signals, all that good stuff. It all reaches us at the end of the day. And of course, it's Interview Tuesday. It means it's time to welcome on a great guest. Today's guest is a newcomer to the program and indeed to the network. He is Barry Martin, the portfolio manager over there at Shelton Capital. Barry, welcome to the Options Insider Radio program.
Thanks, Mark. I'm a big fan. Appreciate you having me on.
Well, Barry, we're glad we can make this happen. And if you're a big fan, you know what comes next. Why don't you give our audience a little bit of an overview of your background in the options and derivative space, as well as what it is you do day to day over there as a portfolio manager at Shelton Capital.
Sure, Mark. Thanks. Where do I begin? Well, I started in the industry in 1998 at a small covered option writing boutique here in the Bay Area. I originally worked as a trader, and then I moved to portfolio management. And after about 10 years there, moved over to Shelton Capital Management to establish their covered option writing capabilities. Shelton Capital Management is a $3 billion multi-strategy asset management firm based in Denver, Colorado. But we also have offices in Greenwich and here in San Francisco. With my strategy and my team, we mainly partner with advisors in offering covered call solutions. With that, we have three different flavors of covered option writing strategies. We have your income flavor, we have your hedging flavor, and then we have your low volatility. With income, we have basically a 30-stock portfolio that's similar weighted to the S&P, where it's basically a buy-right strategy. You know, we're buying equities and selling covered calls. With that, since it's an income strategy, we're typically trying to generate anywhere between 5 to 7% in option premium. And that doesn't include the dividend yield, which is an additional 2%. So really, you know, we're looking at 7 to 9% in income of a portfolio. And we have that in two different packages. We have that in an SMA, where the account minimum is $250,000. But we also have it in a mutual fund, and the mutual fund symbol is EQTIX. EQTIX is 4 stars on Morningstar, and has an 8.5% 12-month trailing yield. So that's really attractive. But it's slightly different than the managed account. Obviously it's a pooled account and has roughly 70 to 80 equities, fully written covered call portfolio. With hedging, we have our concentrated solution where we have an option overlay. Perfect client for that is someone who has maybe say $5 million of Microsoft. They give us $1 million of that to sell covered options on. We've reduced the risk of their portfolio. We have $1 million performing with covered options, $4 million not. With that, we're typically trying to generate anywhere between 2 to 6% in cash flow. It's really determined on the underlying volatility of that position. We also do collars and hedging on those concentrated positions. So if someone's looking for a concentrated solution, that might be appropriate. And then the third strategy that we run is a low volatility strategy. And that's our ETF strategy, basically diversified ETF. We have anywhere between 7 to 10 different ETF asset classes where we plot along an efficient frontier, and then we sell covered calls on the ETF. So what we're really trying to do on a modern portfolio theory is kick it in the top left quadrant where those options lower the volatility while receiving similar returns. So overall, we've of the 12 years I've worked here, we're about $750 million that we manage in covered option writing of the $3 billion total at our firm.
It's quite a bit to unpack there, Barry. Interesting. I like that. A lot of places to start off. But I think it's interesting. Speaking of starting off, your options origin story is kind of interesting because you cut your teeth effectively in the business by writing covered calls. You don't see too many people have that be their entry point. Maybe they come up through trading or some other areas like that. You came in through a covered call investment boutique and are still doing covered calls all these years later. What is it about covered calls that really speaks to you, Barry? Why does that strategy resonate for you so much?
Well, for me, I like about covered calls because you can do different things with it. Obviously, it's all about perspective and what you're trying to accomplish. If you're looking for income, especially with the yields where it is now and the VIX, basically north of 20, I think it makes a lot of sense. If interest rates go up, if you're really searching for income, it's a solid alternative, especially if you own solid equities. So I think makes a lot of sense. And if you're looking for similar market returns with lower volatility, it's also appropriate. I'm just one of those option geeks that just when you talk to people that love covered options, I'm one of those people. So I'm just a big fan and basically done it for over 20 years now, which is crazy.
And you came over to a firm like Shelton Capital, which I think mostly hangs their hat in the more traditional, long equity and typical type of money management portfolios you see out there. Were they pretty welcoming of the idea when you came in and say, hey, I want to bring these options things, these option writing thing to your firm? Were they pretty receptive of that, or were they maybe a little bit concerned at first?
Well, yeah. So, Shelton Capital started on the retail side, and so I brought a whole advisor channel to Shelton Capital, and I think that's what the most benefit is working with advisors and communicating with their clients on the benefits of options. And I think that basically move to Shelton Capital where it's an appropriate style because back in the day options were not a dirty word. It was hard to communicate to the end client. It was also expensive. But thanks to people like you, the CBOE, Options Industry Council, it's become much more well-known and appropriate, and it's become way more mainstream. So, obviously upper management signed off, and we've done very well.
I'm glad to hear that. Well, let's get into the weeds a little bit because our audience likes to dive deep into the structure of these things. Covered calls, as you mentioned, there are many different ways you could construct a covered call. I could talk to 10 different guests and they would give me 10 different ways they like to structure their covered calls. Some may go out in the weeklies and right at the money. Some may go a little bit farther out, a little bit more out of the money. Some may go in the money. There's all different ways to structure them. Obviously, you have many different funds that you do different things with, as you covered at the top there. But let's start with your basic covered call fund over there at Shelton. Is there a particular percent out of the money? How far out are you going in terms of time to expiration? What's the basic structure for it?
Yeah, typically, we're mainly the underlying equities is mainly value tilted. So It's the lower volatility names that we're selling covered calls on. And with that, obviously times change. A year ago it would probably be a slightly different answer, but typically we're writing 45 to 60 days out with delta in between 35 and 45. That's what our sweet spot is right now. It also, depends in managed accounts. It depends on cost basis and other things. But originally starting, we're writing slightly out of the money, 45 to 60 days out. And then as the program goes on, it really depends on where the underlying equities are. We take a balancing act of what I call the NAV, or the account value, and cash flow. As you know, you can sell options that are at the money consistently and generate a nice amount of cash flow, but we're also looking from a total return standpoint as well, where we don't want to get whipsawed, first of all, and also, we're very much aware of the account value of the stock, where we if times allow us, we'll leave some appreciation of the underlying equity. So, this year has been pretty good for us in regards to selling covered calls. As you know, we can sell these 45 to 60 day options that are almost 10% out of the money while still hitting our 5 to 7% annualized cash flow. So as the VIX and volatility expands, we're able to be more flexible in the options that we sell. So we're not necessarily trying to grab as much option premium as possible in our income thing. We're also looking at a total return strategy in regards to some appreciation of the underlying equities.
In regards to that appreciation, so obviously it's been a pretty upward tilted market for the latter half here of 2020. So I'm imagining there's a few scenarios here over the course of this year where you guys have hit or even blown through your covered call strike. So what are you guys doing in that scenario? Are you letting the underlying get taken away? Are you rolling to readjust? How do you guys approach those scenarios?
Yeah, I think in a market like this, I'm a big fan of covered option writing. I'm talking my book, but I'm a big fan of covered option writing and actually having higher turnover, because with volatility elevated, it allows us to deploy that cash where we feel it's appropriate. So, for example, in February, we had our airlines get called away, went to cash, and we haven't gone back into airlines because it's been somewhat nervous because of the COVID situation, but allows us to stay flexible and deploy cash where we feel appropriate. And so with covered option writing, it gives us flexibility to go to cash. Well, we're not your typical buy and hold value strategy, right? Even though we own value equities and we like to hold them for a certain amount of time, but with covered option writing, it's more shorter dated. And I think, you're looking at today's market. This market is more short dated than it has been in the past. You get news on a vaccine, the market moves. We have an election in January. We have, another election in January, right? We have the election in November. But there's all these moments that are happening that are really moving the market. And I think it's time to stay. It's appropriate to go to cash, to have things get called away, and deploy the cash where we feel it's appropriate. On the flip side, if it is an equity that we like, that we want to continue on or keep on our buy list, then we will roll the position, and then we'll sacrifice option premium to move up the strike price, right? So, if we have the stock at 50, we sell the 55s, and the stock runs to 60, I'll buy it back for $5 and look for another $5 to roll it up, or maybe even take a negative cash flow and get it up to the 65, something along those lines. And that's where we do that, once again, that balancing act between the NAV or, account value and the cash flow generation.
That's interesting. So you have a bit of a, like you mentioned, flexibility, a bit of a customized approach. You roll or let the underlying be taken away based on the situation, which is interesting. You don't have a structured rule set approach at the outset. You're kind of letting the situation dictate. Speaking across the different strategies here, you mentioned you have a covered call fund, but also you have the covered ETF. Is the approach identical for both and just the underlyings are changing, or are you taking maybe a little bit different philosophy with the covered ETF versus the traditional covered call fund there, Barry?
Yeah, the ETF's a little different. We're not necessarily focusing on the options as much from a gain-loss perspective. If the stocks, for example, we're selling covered calls on the spiders. If that goes in the money, then we'll take a loss on the option and roll it up. and then and keep the weightings. Well, actually, we check the weightings every 6 months to where it is on the efficient frontier. So it's traded a little bit differently, but something like that, like our standard deviation in that is about an 8%. So it's really a nice alternative, but it's not really focused on, let's say, income per se, right? It's just focused on the low vol and really just selling covered calls, and then that's more of a systematic, disciplined approach.
And have you had any pause, any reservations about maybe continuing covered calls now that we are, of course, coming on the tail end of the year? We have pretty much every major index and a lot of the stocks at or around all-time highs. Volatility was high, is still, VIX is still in the 20s, but it is coming off those crazy, absurd highs we saw. So going forward, probably less premium for a lot of these call rights and also probably pretty lofty valuations. Does any of that give you pause about maybe diving back into the covered call fray in the near term, Barry?
Yeah, that's a good question. It comes to the fact, though, that, we work with advisors and we partner with advisors in offering these covered call solutions. And we get hired to sell covered calls. I think it's tough to time the covered call, when to put it on, when to take it off situation. So what we do is we stay fully covered at all times, excluding the couple days around options expiration. But in general, once again, we partner with advisors to sell covered calls, and that's what we do. So we'll stick to it.
That's true. It's a bit of a challenging situation because if they're sub-advising to you to write the covered call and you come back to them and say maybe the environment isn't super favorable, they write a covered call, they're going to say, what am I working with you for, right?
Well, it is that part. Selling covered calls on Apple has been tough, right?
Or Tesla, or pick your FANG name, right?
Right, exactly. So, and that's where we sit down with the advisor and the client and go, okay, here's the deal. The best situations before is, the guy has $5 million at Apple, great situation, and $1 million with us. And, it's education. And it goes, okay, hey, we'll do well in choppy sideways, flat down markets. That's where we'll outperform your other $4 million of Apple. But what we're doing here is we've added a different return pattern to your portfolio, and we've reduced your risk. So, if they're on board with that, good. But if they're Apple bullish, then we say, hey, maybe this isn't the right fit, and we don't want to sell covered calls on Apple. Just stay long, and then come back to us when you feel that, we're at an elevated level in your point of view, and, we'll sell covered calls at there.
Speaking of that client demand factor, what's it been like, particularly over the last 6 months, as we've seen this aggressive V-shaped recovery in the markets? Also, a lot of volatility is, on the one hand, volatility may be attractive for people who want to dip their toes into covered calls, but also the explosive upside may be less attractive. So what's it been like from a client demand perspective? You've been hearing people, they've been reaching out to you more aggressively? Have you been hearing a lot of clients and advisors coming to you saying, hey, we're intrigued by this covered call thing, or is it maybe tapered off a little bit? What have you been seeing on your end?
Yeah, we're swimming upstream a little bit because of the I guess what we call it opportunity cost that some of the clients have missed out off the bottom. So we've done really well against the buy rate index from a performance standpoint, but underperformed the S&P. So that's where education comes in, and telling the clients what we're looking at. But in regards to new assets, so those are the existing assets. But in new assets, yeah, we've raised some because it's been attractive. Obviously, yields are low levels. The VIX, I think, north of 20 for now the 197th straight day or something along those lines. I read in the Wall Street Journal. And we're right at 20. But, we are seeing people come our way because of, at the heart of it, it is a hedged equity strategy, right? And so we're starting to see some people use it as a total return strategy. But still, people come back to it as an old income play. That's what we're basically paid to do.
And you also mentioned you guys offer an overlay service as well. That's another one where you could structure your overlay 8 million different ways. So I'm curious, obviously we talked about the covered call side a little bit. How do you guys structure the overall overlay? How far out is the put? How far out of the money? These are the types of details our audience loves, Barry.
Yeah, so we sit down with the client and advisor, and most of it is covered option writing and how we attack it. First, we ask, what their cash flow target is. Typically, we say 2 to 6% annualized, And then from there, we work backwards on where they're looking for their upside, cap would be. It kind of works like a teeter-totter. So as in life, there's no free lunch. If you're willing to take 2% off of Apple, there's some upside target that you're willing to forego. And in this case, it's, typically we can get about a 20 to 25% appreciation of Apple or the stock that meets their cash flow goal. If they're looking for something like 6 or 7 or 8%, that might be in the 15 to 20% range. So really, it's balancing the upside target price from a client and also their cash flow that they're looking to take on. And that cash flow can also be, used to obviously buy puts. So the hedge is put on that way, and it's up to the client advisor where they want or where they feel comfortable to protect themselves on the way down. And so, that conversation that we begin with is very important. It's important to know that the client understands that your upside is capped at a certain level, we don't sell the whole position, all the options at once. It's more of a 20 to 30%, and then if it goes in the money, then we're able to give some flexibility to sell more options at a higher level. But there comes a point where we are fully written at a much higher level, and that's where the client should be okay and sign here that you're willing to let the stock get called away.
Interesting. So you will do it again on a case-by-case basis. When you are putting on the hedge element, though, does it typically all line up in the same month? I know a lot of advisors like a nice, seamless, neat package, so they typically will go for some type of zero-cost type collar all in the same month. Is that the approach you guys go for, or you push the put out a little bit and structure the call to get a certain percentage? How do you guys normally structure those types of collars there, Barry?
Yeah, it's typically neat and clean. For us, it makes more sense from a communication standpoint with the advisor and the client. We're able to be upfront and tell them exactly what we're doing and the cost of doing that, right? And so typically we try and get it as clean as possible. And then when we get to that put, which is maybe 9 to 12 months down the road, then we meet with the client again and see what they would like to do.
Speaking of what you'd like to do, obviously we're heading into an interesting, uncertain year. Hopefully vaccines are on the horizon, but we've seen a lot of back and forth, as you mentioned, with this news, a lot of back and forth, mostly upside of late in the markets out there, vol coming in. Going forward, looking out to 2020, what are some of your outlooks? And when you're talking with your clients and the advisors, what are you expressing in terms of maybe overall valuations here? Are you liking these levels, maybe a little bit reticent at these all-time highs? And in terms of the applicability of covered calls going forward, what are you counseling people looking out to 2020? Excuse me, 2021. We're already done with 2020, thank God.
Hopefully, we're almost done with 2020. We got one more month. With the VIX curve being relatively flat, that means a lot of stuff's pretty much it's unknown. I still think volatility is going to be elevated with COVID and the election, and also, like you're mentioning, is the valuations are extremely high, and so from our standpoint. And with interest rates being where they are, we're obviously big fans of covered option writing. Some sectors that we like more than others. I mean, energy has gotten batted down, but we've liked what we've seen over the past month. We think we can get a couple more months of that. We are, from an economic standpoint, growth is accelerating where it was from 6 months ago, right? Inflation is picking up from where it was, 3 to 6 months ago. So that's beneficial to stocks like energy and technology too. So I still think there's some room to grow in technology. But in general, we're cautious, and we'll continue the process of selling covered calls, and through 2021 and beyond.
Well, Barry, unfortunately, that music means we've come to the end of our journey here on Interview Tuesday for this week. But before we go, if perhaps you want to leave our audience with a little bit of a hint, a little bit of a tease of what's coming down the pike from you guys at Shelton, or perhaps there's a salient point that you really wanted to make but forgot, and you think our audience would find it fascinating. Now is the time, Barry. The floor is yours.
Oh, wow. Well, I just want to thank everyone and for listening in, and I really hopefully everyone still stays healthy and strong to 2021. But that's the main thing. It's just let's get done with this year. And hopefully 2021 will be better, and stay happy and healthy out there.
I can certainly get behind that. And Barry, if folks are interested, they want to learn more about your overlays, your overwrites, covered calls, any of that fun stuff, where should they go? What should they do?
Yeah, go to sheltoncap.com, SHELTONCAP.com, and look at the option overlay services. And you can contact me directly at bmartin@sheltoncap.com if you have any questions.
There you go, sheltoncap.com to learn more. And, of course, stay tuned throughout the rest of the week. We do a lot more than just interviews here on the old network. Coming up tomorrow, of course, is Education Wednesdays. We get you a double dose of Options Playbook Radio and Options Bootcamp. Thursday, we're back with episode 2 of the option block, as well as This Week in Futures Options, rounding out the week there on Friday with Volatility Views. And it all kicks off again on Monday, Crypto on the option block, all the way through to another Interview Tuesday and another episode of Options Insider Radio.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.